Hi everyone. So let's take a minute and talk about the closing process. So far in your accounting journey, we have learned the basic journal entries and posting, and then we did an unadjusted trial balance. Then in Chapter 3, we learned how to do our adjustments, the adjusting process, journalized and posted, and then did what we call an adjusted trial balance. Then we take those up-to-date numbers, we do our financial statements, and now we're at the time for our closing process. The closing process is the last step in our accounting cycle, and we are literally just getting our accounting records ready for a brand new accounting period. So, the first thing we want to talk about is the fact that we have two categories of accounts. We have permanent accounts and we have temporary accounts. As you could probably figure, permanent accounts are the ones that always stay, and temporary accounts are the ones that we close. When we say we're going to close an account, we mean that we're going to make it have a big old egg balance, a zero balance, okay? So, to make an account have a zero balance, what would I do? Well, if the account has a positive $2,000 balance, what would make it be zero? That's right, a negative $2,000, because 2,000 minus 2,000 gives me what? Zero. So we are literally going to do the opposite when I want to close an account. If it has a debit balance, then I will credit it for that amount. If it has a credit balance, then I will debit it for that amount. Make sense? Okay, so why? Why do I want to make some of these accounts have zero balances? Well, we know, because we have talked about it over and over, that financial statements are one of the major outputs of our accounting system, because people inside and outside our company use that information to make decisions. Well, do we want to make decisions with up-to-date, brand new information, or do we want to make decisions with information that's a year old, 2 years old, 20 years old? No, that wouldn't be any good, right? We want to use the most up-to-date information. So, my revenue account. If my revenue account was the same revenue account I had been using for the whole 12 years I've been in business, then how would I know how much my profit was for this accounting period? I mean, I could figure it out, but it would take a whole lot of going back and calculating and looking. So to make it quicker and to know that we always have the right number, if we start with zero at the beginning of every single accounting period for my revenue account, then I know that the balance in that account is just my revenue from this accounting period. So revenues are one of our temporary account types. At the end of every accounting period, we will make them be zero to start fresh the next accounting period. Same thing with expenses. I don't want to be running my business based on information about my expenses from 5 years ago. I only want my expenses from this accounting period. So, therefore, if I'm always starting fresh, then when I'm doing my income statement, I know I'm saying this accounting period's revenue minus this accounting period's expenses gives me my profit, my net income for this accounting period. Okay? And the last account that we close, our last temporary account, is the owner's drawing account. We can't keep penalizing the owner and reducing the equity by the same $1,000 he took out in 1992 in 2022. That wouldn't make sense, would it? We're only reducing the equity by the amount the owner withdrew in this accounting period. So these are my temporary accounts: revenues, expenses, and drawing. What about my permanent accounts? Well, let's talk about assets. How would you feel if you had $86,000.26 in your checking account on December 31st? You woke up on January the 1st, a new year, and your checking account balance was 0. Oh well, it's a new year, you're broke. Got to start over. I go to sleep in my house on December 31st. I wake up on January the 1st and I'm homeless because that asset's just gone because it's a new accounting period. No, we would not like that very much. So therefore, we do not close our assets. Our assets are permanent. What about liabilities? Well, let me just say, if I could shop all year and put everything on credit cards and build up a ton of debt and then go to sleep on New Year's Eve and wake up on January the 1st and be debt free, that would be nice. But, I mean, creditors don't care what day it is, one accounting period or 2 accounting periods later, they want their money. So, unfortunately, I guess, we cannot close liabilities. And then, what about the capital account? The capital account represents the value of the business to me, the owner. I'm working hard to build that up. I don't want to start over every year. So, capital is a permanent account. So assets, liabilities, and capital are our permanent accounts. And if you think about it, let's just test your big picture knowledge here. If assets and liabilities are permanent, then capital has to be, doesn't it? Why? It goes back to our accounting equation, that's right. Because assets minus liabilities equals equity or capital. So if the assets and the liabilities are going to be permanent, then we know that our equity or the capital account has to be permanent. Just a little test there, make sure you're seeing how this all works together. So that is why we have the closing process, and those are the accounts that we close and the accounts that we do not close. We will talk about the actual entries to close these temporary accounts in another video. Thanks for watching.